Hi, this is Denise Evans, broker, and I'm going to talk to you about commercial lender requirements in case there's some mystery about why some loans get turned down and why others do not. A little bit about me. I'm an active commercial real estate broker and consultant. I am open to co-brokering properties. If you want a specialist in real estate and commercial real estate, give me a call and we'll work something out together. I'm a retired litigation attorney specializing in real estate and banking defensive litigation. I'm a former clinical professor of real estate at the University of Alabama Culverhouse College of Business, and I'm a nationally published author from McGraw-Hill, Sphinx Legal, and Kaplan Dearborn. Well, let's talk about the lender requirement most of us are familiar with, and that's the loan to value ratio, abbreviated LTV. Different lenders have different loan to value ratios. It might be 75% and it might be 85%. Value is defined by the lender as the appraised value or the purchase price, whichever is less. If the purchase price is $400,000, but the appraisal is $500,000 and the loan to value is 75% for that lender, you will be able to borrow 75% of $400,000, not 75% of $500,000. Now, there is an exception for development loans for new construction and for some rehab, but we're just talking about the typical commercial loan here. One thing you might not be familiar with is the debt coverage ratio, also sometimes called the debt service coverage ratio. Okay, and that is usually anywhere from 1.15 to 1.2. Now we're not talking here about debt service coverage ratio loans, which is a particular loan product for residential rental property, and those loans are then packaged and sold into securitized trusts. That is a completely different thing, and we have a different YouTube video about that. This is the commercial real estate ratio called debt service coverage ratio or debt coverage ratio. And you arrive at that by dividing the annual net operating income by the annual mortgage payments to calculate the DCR. And if you think about a DCR of 1.2, 1.0 would be the annual mortgage payments are exactly equal to the net operating income from the property. A 1.2 means that that lender wants about a 20% cushion there, that even if there are some surprises regarding vacancies or expenses, you will still be able to make the mortgage payments because of the cushion. That's the reason for the DCR or DSCR ratio that lenders require. Same thing, just people call it different things. Will this loan be approved as an example? The purchase price is $400,000, which is also the appraised value. The loan to value ratio required by the lender is 85%. So that will support a loan amount of $340,000, which is 85% of $400,000. The interest rate for this loan is 6.75%, with the payments calculated as if the loan would fully amortize over 25 years, but the loan will mature in 5 years. For purposes of this example, we're going to say the net operating income is $32,000. The mortgage, as indicated on this slide, would result in annual mortgage payments of $28,189. If you take the $32,000 net operating income and divide it by the $28,189 debt service, you get 1.13. If the lender requires 1.15 or more, this loan will not be approved, even though the appraisal came in right, even though the credit score is perfect, even though all these other things, it will not be approved for this reason, because of the debt coverage ratio. So what can you do now that you know this? You can pay a larger down payment, so the mortgage payments are smaller. If the mortgage payments are smaller, the annual debt service is smaller, and your ratio might be higher. You might meet the lender requirements. You can negotiate a lower interest rate or a longer amortization period, so the payments are smaller. Same result. Or you might be able to negotiate interest-only payments for the first 2 years, which means your mortgage payments are lower and your net operating income to mortgage payment ratio is going to be higher, and you hit the lender's requirements. Or you might shop for a different lender. So those are the two most important metrics for commercial lenders. And when it comes down to the debt coverage ratio, this is what you can do. And if you know in advance this might be an issue, you can work on your numbers before you take it to the lender, so you make sure that net operating income is going to come in appropriately to support the mortgage. And that if you're refinancing, that might be something as simple as increasing the rents $10 a month, which is not going to encounter any tenant resistance. If you have any questions, or if you're interested in co-brokerage opportunities, if you're residential agents or brand new commercial agents with a deal that's maybe larger than your experience, contact me. I'm open to co-brokerage opportunities across the entire state of Alabama. I'm Denise at butlerevansrealestate.com. My phone number is 205-310-3799 in the Central Time Zone.